Are sellers finally giving in the US housing market in 2024? Well, new data from Realtor.com shows that home prices are on the decline, with the median list price for houses in America dropping down to $410,000 at the end of 2023, which is down almost 9% from the peak in June 2022. However, these prices are still very, very high compared to what they were before the pandemic, when the median list price was $300,000 at the end of 2019. Today, it's $410,000. So most home buyers across America are still struggling with affordability, especially with mortgage rates still resting in the high 6% range. With Mortgage News Daily reporting that the 30-year fixed mortgage rate ended the week at 6.7%, which is down from the peak of 8% back in October, but is still significantly higher than the levels during and before the pandemic. And it's this lack of affordability that's causing a huge collapse in home buyer demand. 2024 is starting out to be kind of underwhelming in terms of how many home buyers are going and applying for mortgages and touring homes. With Redfin's home buyer demand index down 9% year over year to begin 2024 and down almost 40% from its levels in 2022. And so ultimately, we're going to need to see both prices and mortgage rates decline more into the future before these buyers come back, especially in housing markets that are very overvalued. With data on Reventure app showing the most overvalued housing markets in America here in red. For instance, home prices in a metro like Atlanta are 33% overvalued compared to their long-term norms, suggesting that there's lots of room for prices to decline if inventory levels in the metro go up enough. Similarly, another metro that's very overvalued is Miami. Home prices in Miami are about 33% overvalued, and what's especially concerning about that is today's overvaluation levels now match the previous peak in 2006 before the massive housing crash that hit Miami and caused values to drop 50%. And interesting, in the last downturn, prices in Miami became very undervalued, and it was a great time to buy. And if you're someone who tracks the data on overvaluation and inventory and seller price cuts, you're going to have a better chance at spotting the right time to get into the market and securing a house at a good price. Because right now, there are a lot of sellers in America's housing market who are giving in, who are starting to reduce the price. Like on this listing, everyone, this is a townhouse, a 3-bed, 4-bath. Actually, I don't know why there's so many bathrooms if there's only 3 bedrooms. But anyway, it's 2,100 square feet. It's listed now for $498,000. And you can see the seller just did a $52,000 price cut, which reduced the value by 9%. Now, here's what's really interesting. If you look at the Zillow value history, you can see that the current list price is close to what Zillow estimated the value of the home to be back in about early to mid 2021. However, mortgage rates are much higher today than they were 3 years ago, which means that your payment, if you were to buy that house with a mortgage, would still be pretty hefty at around $3,400 a month, which would be over $40,000 a year, which I think for most people in this economy in 2024, it's probably too much money. And I think ultimately what's happening in the housing market right now is that a lot of fatigue is starting to set in for home buyers. Particularly, I know you guys have been watching my channel. A lot of you have been looking to buy a house for the last 2 to 3 years, and a lot of you are getting frustrated at the fact that, even if the prices have come down a bit, they're still very, very high, and it doesn't feel affordable. And so I think a lot of people are just losing interest in dropping out of the market. That's why the mortgage applications today are near rock bottom levels. That's why very few people are searching for homes on Google. Because there's a very interesting function on Google called Google Trends, which allows you to look at the search interest in different terms. And for instance, homes for sale, you can see the search interest here in early 2024 is an index level of 47, which is close to the lowest level that we've seen in the last 5 years. In particular, you can see it's actually half of what the levels were in 2021 in that peak pandemic home buying boom. And so this is actually kind of a leading indicator, everyone. If you wanted to track, like if there would be a turning point in the housing market, we would probably see more people searching for homes for sale on Google and this indicator trending up. However, we're not seeing that yet. In fact, we're seeing the exact opposite. It's still at a very, very low level. And I think home buyer interest in the housing market is going to stay at a low level until we see meaningful declines in prices, right? I think that's what a lot of you guys are waiting for out there. And I think actually one thing that offers a clue as to what needs to happen in the housing market in 2024 to bring buyers back is what's going on with home builders. Because very interestingly, home builders across America, they've carved out a very interesting niche for themselves in this housing market where they've actually kind of gotten buyers to come back in. The new home sales for builders, they're back to, let's call them, normal pre-pandemic levels. And the reason is because the builders have been very aggressive in cutting the price and lowering mortgage rates. With the average sale price for newly built houses in America now down about 15% from its peak. So it peaked in late 2022 at 570,000. Now the average is down to 490,000, which is still expensive. However, that's about a 15% reduction. In addition, these builders are offering generous mortgage rate buydowns, buying down mortgage rates to as low as 4.99% for the full term, while the market mortgage rate is still closer to 6.5% or 7%. Here's the problem, everyone. Builders only account for a very small share of the housing market. About 15% of home sales come from builders. Their annualized sales are currently around 600,000 per year compared to house resales, existing homes, which are close to 4 million a year. So the builders, they're telling you where the market needs to go, but they occupy a small share of the market. So we're not going to see real movement in buyer demand until we see these house resales, like the existing sellers, capitulate more and lower the median list prices by more, which is a trend that's extremely market dependent. I mean, there's some cities right now where the sellers are aggressively cutting the price, where they are getting more realistic when they list their house right away, whereas there's other cities where the sellers are still in la land jacking up the price because they feel like they have the leverage to do so. We go here on Reventure app and look at a data point called sale inventory deficit, which looks at how inventory compares today to the long-term average. We can see that it's the areas in blue in America where the sellers, let's just say, are being the most unrealistic, because it's the areas in blue where the inventory is the lowest, right? Like metros like Hartford, Connecticut, and Cleveland, Ohio, and down in Chicago. In Chicago, inventory is down 42% from long-term norms. So if inventory is down 42%, like the sellers still have the leverage, they're still going to try to, maybe increase the price or not cut the price. However, if we go down to Texas, we can see in Dallas, Fort Worth, inventory is up 15% from average. In Austin, it's up 30% from average. So it's in these areas in Texas where the sellers are having to get much more aggressive in cutting the price. Like here's a house south of Dallas on the market for $360,000. This is a new build. Actually, it's a 4-bed, 3-bath, 1,900 square feet. This actually maybe seems not so bad. It's a modern looking home. The finishes look okay. And in this case, the seller has cut the price by about $30,000 or about 8%. Your monthly payment on this house would be around $2,500 a month or $30,000 a year. However, it's not selling. It's been on the market for 124 days, and they're talking in the description about how the home qualifies for 100% financing. I'm curious about what that even means. How would this home qualify for 100% financing? Maybe is the seller willing to hold back some paper? But I think actually, folks, as we dig into the history on this listing, the reason it's not selling is because the current owner actually bought it in August 2022 for around $339,000. So this is the issue. This owner bought it and then tried to flip it pretty quick for a profit. They're having to cut the price, but they still have it listed for more than what they bought it for. And I think a buyer in today's market, if you see that, you're saying, yeah, I don't want to deal with that. The price needs to be lower than it was in 2022, given how much the mortgage rates have gone up in order to, entice a buyer in this market. Now, another area of the country where we're actually seeing sellers cut the price is, interestingly, Florida, everyone. And Florida is an interesting case because for the longest time, I was predicting a downturn in Florida. It wasn't happening. Florida's housing market was holding on. But now at this point in 2024, something big seems to be going down in Florida right now. With the inventory levels skyrocketing over the last year, particularly in Southwest Florida, everyone, take a look at this. Year-over-year inventory growth in Northport and Cape Coral and Naples, it's 50 to 100%. Homes for sale almost doubling. I mean, it's like a hockey stick. We went from only 1,900 homes for sale in Cape Coral, Fort Myers 2 years ago to now 8,500 homes for sale. Similarly, in Northport, Sarasota, we went from 1,400 homes for sale to 6,700 homes for sale. And in Tampa, St. Pete, we went from 4,000 homes for sale to over 12,000 homes for sale. And so these climbing inventory metrics in Florida, everyone, this is a signal that sellers are going to start to get a bit desperate and be forced to reduce the price due to oversupply occurring in the market. And it just so happens that a lot of these areas in Florida are very overvalued, with the home price overvaluation rate in Tampa registering 33%, which is near the highest rate of all time, even higher than the overvaluation we saw in the '06 bubble. And just to be clear, everyone, I think some of you might have some questions. How is this overvaluation calculated? Well, we look at the home value to income ratio over time. And we can see over the last 20 years in Tampa, the average home value to income ratio is 3.9, meaning the typical house traded for 3.9 times median income. However, today the typical house is trading for 5 times the median income, which is the signal of a bubble. This situation, it's not going to last. The home value to income ratio is going to go down into the future in Tampa and many other cities in America. And the way that that's going to happen is through some combination of either home prices going down and or incomes going up. That's what we need to see, declining prices and rising incomes in order to return affordability to the market and make it so literally like buyers can like qualify for mortgages. Because right now, lots of buyers can't even qualify for the mortgages. The debt to income ratios across the US housing market for home buyers are close to 40%, meaning that the typical home buyer who's buying a house in today's market, 40% of their gross income is going to mortgage and debt payments. I mean, that's a bad sign. That's even worse than it was in the middle of the mid 2000s during the peak of the last bubble. So that's not sustainable, everyone. We need to see those debt to income ratios go down. But one thing to watch out for in 2024 is what's going to happen with a lot of these homeowners who are locked into low mortgage rates. This has been a big trend in the housing market since the mortgage rates went up over the last 1 to 2 years. Lots of buyers locked in with low rates. According to Redfin, 89% of people with mortgages have an interest rate below 6%, down from a record of 93% in 2022. So there's some improvement. You can see this chart here from Redfin shows the breakdown of people by their mortgage rates. Green is below 3%, blue is 3 to 4%, darker green is 4 to 5%, light orange is 5 to 6%, and dark orange is above 6%. So we still have lots of people, over half of mortgage holders have a rate under 4%, and this is kind of freezing the market. In some cases, really the only sellers we're seeing in certain markets are those who are selling because of divorces, new jobs, or death in the family. And so this lock-in effect that a lot of people have with having their low mortgage rates and not wanting to sell, it's something that's caused new listings and inventory to remain lower for longer than home buyers would like. So there's not as many listings hitting the market, particularly in a place like Southern California. Like in Los Angeles and San Diego, the inventory is down 29% from normal. We got to see more inventory in a lot of these markets to actually unlock price declines. And on that front, I think there is some good news on that front, everyone, because more and more it seems like some sellers are coming out of the woodwork, and the inventory levels on the US housing market, they're actually holding up pretty good this winter so far, at a time period where inventory typically goes down. Overall, we're not actually seeing that big of a decline, with the inventory of homes for sale dropping from 755,000 in November to 714,000 in December. You can see this is actually a smaller percentage drop than we typically see in most winter periods, and that we could see in the spring these inventory levels suddenly take an upward turn closer to this long-term average of about 1 million homes on the market. And really, that's what I'm going to be looking for in the 2024 housing market over the next couple months, those inventory levels. Are we going to start to see the inventory begin to grow significantly in February and March over the next couple months? That's what you got to watch out for as a home buyer. And the way to do that, go to ReVenture app and type in the name of your city, and then change the data point to for sale inventory, and for free, analyze the inventory trends in your market. And in particular, you're going to want to see, are the level of homes for sale getting back closer to this long-term average? Because if they are, that's good news. And in some cases, the inventory is now way above the long-term average, which means that prices are more likely to drop. After you check out that inventory data, I would encourage you to sign up for a premium account for a cost of $39 per month, where you can access data points like overvaluation rate to see how overvalued home prices are in your zip code, and also to see the price cut percentage. How many sellers are cutting the price right now, and how does that compare to the long-term averages? Those are data points you're going to want to see. So go to www.reventure.app right now to check out that data so you can make a more informed decision in 2024 as a home buyer or investor.